Look, I need to show you something that's happening right now in the silver market. And I'm not talking about price predictions or technical analysis. I'm talking about physical metal disappearing from dealer inventories at a pace I've never seen in my career. 3 days ago, I started getting calls from dealers I've known for years. These aren't the guys who panic over every price move. These are the people who've been in this business for decades, who've seen every market cycle, every squeeze, every shortage. And they're telling me something I honestly didn't think was possible in today's market. They're running out of silver. Not low inventory running out. Not we need to reorder running out. I'm talking about major dealers telling customers they can't fulfill orders. I'm talking about premiums jumping $5, $6, $7 over spot in a matter of days. I'm talking about delivery times that used to be 3 to 5 days now, stretching to 3 to 4 weeks, if you can even get a delivery date. And here's what makes this different from every other shortage we've seen. This isn't driven by retail panic. This isn't a Reddit army piling into silver coins. This is something much bigger, much more structural, and frankly much more concerning for anyone who understands how these markets actually work. Let me walk you through what's actually happening, because the mainstream financial media isn't covering this. They're still talking about gold hitting new highs. They're still focused on the dollar. They're still missing the biggest story in precious metals right now. The silver market has always operated on a knife's edge. Unlike gold, where most of the metal ever mined still exists in vaults and jewelry, silver gets consumed. It gets used up in industrial applications and it's gone. Solar panels, electronics, medical devices, water purification, batteries. Every year, billions of ounces of silver are used in ways that make it economically impossible to recover. For years, this wasn't a problem, because we had mine supply coming online. We had recycling, and we had enough above-ground inventory to smooth out any temporary imbalances. But something fundamental has shifted in the past 18 months. Global silver mine production peaked. Not temporarily, structurally peaked. The major silver-producing countries are seeing declining output from their primary mines. Mexico, Peru, China, the big three producers, they're all showing declining production trends. And unlike gold, where you can find new deposits and bring them online relatively quickly, silver is different. Most silver comes as a byproduct of other mining operations. Copper mines, lead mines, zinc mines. You don't just decide to produce more silver. You need the economics of those base metal operations to work first. Meanwhile, industrial demand has exploded. The solar industry alone is consuming over 100 million ounces of silver per year now. Every solar panel requires about 20 grams of silver. And with the global push toward renewable energy, with countries setting net zero targets, with the solar industry projected to double in the next 5 years, you're looking at demand that's not just growing, it's accelerating. Electric vehicles use twice as much silver as traditional cars. Data centers, 5G infrastructure, military applications, all of these are silver-intensive technologies that are growing exponentially. We're not talking about jewelry demand that can flex with price. We're talking about industrial applications where silver is irreplaceable, where manufacturers will pay whatever they have to pay because the alternative is shutting down production lines. Now, here's where it gets interesting. For years, the paper-silver market, the futures market, the COMEX, has been able to set the price of silver through financial contracts that rarely result in physical delivery. Banks and trading firms could sell unlimited paper contracts, suppress the price, and as long as nobody actually demanded physical delivery, the system worked. But something broke in that mechanism recently. The premium between paper silver and physical silver has blown out to levels we haven't seen since the chaos of early 2020. You can buy a silver futures contract for one price, but try to actually take delivery of that metal, try to convert that paper into physical bars or coins, and suddenly you're paying $7, $8, $9 more per ounce. That spread, that disconnect between paper and physical, that's telling you something critical. It's telling you that the people who've been selling paper silver, the banks and trading firms who've been happy to sell you contracts, they're not so confident anymore about their ability to deliver physical metal if you actually ask for it, and some very large players have started asking for it. Central banks have been accumulating silver quietly, not at the pace they're buying gold, but consistently, steadily building positions. Sovereign wealth funds are allocating to physical silver. Large institutional investors who previously only held paper exposure are now demanding physical delivery and storage. When a central bank or a sovereign wealth fund decides they want physical silver, they're not buying 100 ounces. They're buying millions of ounces. And they're taking it off the market permanently. They're putting it in vaults where it's not available for industrial use, not available for retail investors. not available for anything except sitting there as a strategic reserve. The COMEX silver inventories have been declining steadily. Registered silver, the metal that's actually available for delivery against futures contracts, has dropped to levels that represent just a few days of global industrial demand. Think about that. The entire registered inventory of the COMEX, the exchange that's supposed to be the backbone of silver price discovery, holds less silver than the world's industries consume in a week. Now, I want you to understand what happens when a market this tight faces a supply shock. And we're facing multiple supply shocks simultaneously. First, there's a major silver mine in Peru that's been offline due to community protests. This mine produces over 20 million ounces per year. It's been shut down for months, and there's no clear timeline for when it restarts. That's 20 million ounces that aren't coming to market. Second, there's a refining bottleneck. Even when you have silver concentrate coming out of mines, it needs to be refined into the pure silver that industry needs. The major refineries are running at capacity. They can't process more material even if it was available. And building new refining capacity takes years and hundreds of millions of dollars in investment. Third, and this is the one that nobody's talking about, there's a logistics crisis in the physical silver market. The companies that transport silver, that ensure silver shipments, that provide secure storage, they're all operating at capacity. You can't just call up a truck and move 10 million ounces of silver across the country anymore. The infrastructure for physical metal movement is strained in ways it hasn't been in decades. So you have declining mine supply, surging industrial demand, central banks accumulating, refineries at capacity, and logistics constraints. Any one of these would be significant. All of them happening simultaneously creates a situation where the physical market can seize up very quickly. And that's exactly what we're seeing right now. Dealers are telling me they're getting calls from industrial users, companies that normally buy silver through established supply chains, who are now coming to the retail market trying to secure metal. These are companies with long-term contracts with refineries, companies that have never had to worry about silver availability, and they're scrambling. When industrial users start competing with retail investors for physical metal, when companies that need silver for manufacturing are bidding against people who want silver for investment, that's when you know the market structure has fundamentally changed. Now let me pause here for a second because this connects to something important for anyone thinking about wealth preservation and retirement security. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical precious metals into your retirement account without tax penalties, how the process actually works, what the costs are, all the details you need to make an informed decision. Worth checking out if that's relevant to your situation. Because here's the thing, what we're seeing in the silver market right now, this supply shortage, this disconnect between paper and physical. This is a preview of what can happen in any market when the financial system's promises run into physical reality. And a lot of people's retirement accounts are built entirely on financial promises, on paper assets, on the assumption that when you need to convert those numbers on a screen into actual purchasing power, the system will deliver. The silver market is showing us what happens when that assumption gets tested. Anyway, back to what's happening right now and where this goes next. The price of silver has been remarkably stable given what's happening in the physical market, and that tells you something important about how disconnected the paper market is from physical reality. The futures market, where most price discovery happens, is still trading based on financial flows, on technical levels, on what algorithms think silver should be worth. But the physical market is screaming something completely different. When premiums blow out like this, when dealers can't get metal, when delivery times extend, that's the physical market telling you the paper price is wrong. It's telling you that silver is worth more than the futures market says it is, because if it wasn't, these shortages wouldn't exist. Eventually, these two markets have to converge. Either the paper price rises to meet physical reality, or the paper market loses credibility entirely and people stop using it for price discovery. Both scenarios are bullish for anyone holding physical silver. But the second scenario, the loss of confidence in paper markets, that's the one that leads to true price discovery, to prices that actually reflect supply and demand fundamentals. And we're seeing early signs that this convergence is beginning. Large investors who previously held silver through ETFs are now demanding physical delivery. They're willing to pay the premium, willing to deal with storage costs, willing to accept the inconvenience of holding physical metal, because they no longer trust that their ETF shares represent actual silver that they could access if they needed it. This is creating a feedback loop. As more investors demand physical, as more metal moves from ETF vaults into private storage, the available supply shrinks further. That pushes premiums higher, which attracts more attention to the shortage, which drives more people to secure physical metal, which tightens supply even more. The silver market is relatively small. The entire annual mine supply is worth maybe $30 billion at current prices. That's less than the market cap of many individual tech stocks. It doesn't take much capital flowing into physical silver to overwhelm the available supply. And here's what concerns me most about the current situation. We're seeing this shortage develop during a period of relative economic stability. We're not in a financial crisis. We're not seeing bank runs or currency collapses. This is happening in what most people would consider normal market conditions. What happens when we do face a crisis? What happens when confidence in financial institutions wavers? What happens when people who've never thought about physical precious metals suddenly decide they want some insurance against system risk? The silver market can't handle that kind of demand surge. The infrastructure doesn't exist. The above-ground inventory isn't there. The refining capacity isn't there. The dealer networks aren't sized for that kind of volume. We saw a preview of this in March 2020 when COVID hit. Silver premiums spiked to $10, $12, $15 over spot. Dealers stopped taking orders. Mints shut down. The U.S. Mint couldn't produce enough silver eagles to meet demand. And that was just retail panic buying. That wasn't institutions, wasn't central banks, wasn't industrial users scrambling for supply. Imagine that scenario, but with industrial users competing for metal, with central banks accelerating purchases, with large institutions demanding physical delivery. The premium explosion we saw in 2020 would look tame by comparison. Now, let's talk about what the smart money is doing. Because while retail investors are just starting to notice these shortages, sophisticated players have been positioning for this for months. There's a reason why silver mining stocks have been outperforming the metal itself recently. Investors who understand the supply dynamics know that if physical silver becomes scarce, if premiums stay elevated, the companies that can actually produce silver are going to see explosive profit margins. A silver mining company that can produce silver for $12 an ounce and sell it for $30 is already profitable. But if premiums push the effective selling price to $37 or $40 while production costs stay the same, you're looking at margin expansion that flows straight to the bottom line. The major silver producers are trading at valuations that assume silver stays range-bound forever. They're priced for a world where supply and demand stay balanced, where the paper market continues to function smoothly, where physical shortages are temporary anomalies that get resolved quickly. But if we're entering a structural shortage, if the supply deficit is real and persistent, if industrial demand continues to grow while mine supply declines, these companies are dramatically undervalued. And the smart money knows it. You're seeing insider buying at silver miners. You're seeing strategic investors taking large positions. You're seeing merger and acquisition activity as larger companies try to secure silver production capacity before the market fully prices in the shortage. The other thing happening quietly is that industrial users are starting to stockpile. Companies that use silver in manufacturing are building larger inventories, securing long-term supply contracts, doing whatever they can to ensure they won't face production disruptions due to silver shortages. This is rational behavior for any company that depends on silver, but it accelerates the shortage. Every ounce that goes into industrial stockpiles is an ounce that's not available for investment demand, not available for other industrial users, not available to stabilize the market. And once companies start stockpiling, once the narrative shifts from silver is available to we need to secure supply before it's gone, you get a rush for the exits. Every industrial user tries to build inventory simultaneously. Every investor who was thinking about buying silver decides to act now rather than wait. Every dealer tries to secure more metal from refineries and mints. That's when markets break. That's when you see price moves that seem impossible, premiums that seem irrational, shortages that seem like they came out of nowhere, but were actually building for months or years. The silver market is showing all the warning signs of being in the early stages of that kind of breakdown. Now, I want to address something that always comes up when we talk about silver shortages. People say, but silver has been in shortage before, and the price didn't explode. Why is this time different? Fair question. And the answer is that previous shortages were temporary and localized. A mint couldn't produce enough coins, so premiums spiked on retail products. But industrial users could still get metal, or industrial demand surged temporarily. But investment demand was weak, so the market balanced. Or mine supply dipped, but recycling increased and above-ground inventories filled the gap. What's different now is that all the buffers are gone simultaneously. Retail demand is strong. Industrial demand is at record levels and growing. Mine supply is declining. Recycling can't keep up because so much silver is being used in applications where it can't be recovered. Above-ground inventories are at multi-year lows. Central banks are accumulating. ETF investors are demanding physical delivery. There's no slack in the system. There's no inventory buffer to absorb a demand spike. There's no spare refining capacity to process more material. There's no quick way to bring new mine supply online. The market is tight in a way it's never been tight before, and it's tight across every segment simultaneously. And here's the kicker. Most investors don't own any silver. Most portfolios have zero exposure to physical silver. Most financial advisors never recommend it. Most retirement accounts don't hold it. So when this shortage becomes mainstream news, when CNBC starts covering it, when your neighbor asks you about silver, you're going to see demand from people who've never bought precious metals before. And that demand is going to hit a market that's already struggling to meet current demand from existing buyers. The math doesn't work. You can't have millions of new buyers entering a market where dealers are already rationing supply to existing customers. Something has to give. Either prices rise dramatically to ration demand, or the market simply stops functioning as sellers refuse to sell at prices they think are too low. We're already seeing the early stages of that. Dealers are raising premiums not because they're greedy, but because they can't replace inventory at current prices. They're selling metal they bought months ago, and when they try to restock, they're finding that wholesalers want more money, refineries want more money. Everyone up the supply chain is demanding higher prices because metal is scarce. That's not speculation. That's not manipulation. That's basic supply and demand playing out in real time. Now, let's talk about the elephant in the room. The banks and trading firms that have been short silver for years. These are the institutions that have sold paper silver contracts, that have bet on prices staying low, that have profited from suppressing silver prices through the futures market. What happens to them in a physical shortage? If they've sold contracts promising to deliver silver, and they can't actually source physical metal to fulfill those contracts, they face a choice. Buy silver at any price to cover their obligations, or default on their contracts and face legal and reputational consequences. Neither option is good for them. Buying silver at elevated prices to cover shorts means taking massive losses. Defaulting on contracts means destroying their credibility and potentially facing regulatory action. This is why short squeezes in physical commodity markets can be so violent. Unlike stocks, where you can always buy shares to cover a short position, physical commodities have hard supply constraints. If the metal doesn't exist, if it's not available at any price shorts can't cover, they're trapped. We saw this play out in nickel recently when a short squeeze on the London Metal Exchange forced the exchange to halt trading and cancel trades. We saw it in natural gas markets when physical delivery constraints caused prices to spike to levels that bankrupted trading firms. Silver is vulnerable to the same dynamic. The short interest in silver futures is enormous relative to available physical supply. If a significant portion of those shorts demand physical delivery, if industrial users start taking delivery instead of rolling contracts, if investors lose confidence in cash settlement, the shorts are in serious trouble. And the thing about short squeezes is that they're self-reinforcing. As prices rise, shorts face margin calls. To meet margin calls, they have to either post more cash or cover their positions by buying. Buying pushes prices higher, which triggers more margin calls, which forces more buying. In a market as tight as silver is right now, that feedback loop could push prices to levels that seem absurd until you understand the mechanics of what's happening. I'm not predicting that we see a short squeeze tomorrow or next week, but I am saying that the conditions for one are in place in a way they haven't been in years. The physical market is tight, the paper market is heavily short, and confidence in the paper market's ability to deliver physical metal is eroding. That's a powder keg. All it needs is a spark. The spark could be a major industrial user demanding physical delivery. It could be a central bank announcing a large silver purchase program. It could be a mine closure that takes significant supply offline. It could be a geopolitical event that drives safe haven demand. It could be a technical breakout that triggers algorithmic buying. Or it could be something as simple as enough retail investors deciding they want physical silver and overwhelming dealer capacity to fulfill orders. Any of these could be the catalyst that pushes the silver market from tight to broken. Now here's what you need to understand about market breaks in physical commodities. They don't happen gradually. They don't give you time to react. One day the market is functioning normally. Premiums are elevated, but metal is available. And the next day, dealers are out of stock, premiums have doubled, and you can't buy silver at any price. We saw this in palladium a few years ago. The market was tight, everyone knew there was a supply deficit, and then suddenly you couldn't source palladium. Prices went from $800 to over $3,000 in less than 2 years. Industrial users were panicking. Auto manufacturers were scrambling to secure supply. Silver is a much bigger market than palladium, but the dynamics are similar. Tight supply, growing demand, limited above-ground inventory, and a paper market that's disconnected from physical reality. The difference is that silver has a much larger retail investor base. When palladium spiked, most people didn't notice because they don't own palladium. But millions of people own silver. Millions more have thought about buying silver. When silver starts moving, when the shortage becomes obvious, you're going to see attention and capital flow into this market in a way that palladium never experienced. And that attention, that capital flow, is going to hit a market that's already struggling to meet demand. I want to be clear about something. I'm not telling you that silver is going to a specific price by a specific date. I don't know if we're going to see $50 or $75 or $100. I don't know if this plays out over months or years. What I am telling you is that the physical silver market is showing signs of stress that indicate a structural shortage is developing. The supply and demand fundamentals are the most bullish they've been in decades. The disconnect between paper and physical is widening. The conditions for a significant price move are in place. And most importantly, the window to acquire physical silver at reasonable premiums is closing. Not closed yet, but closing. Every day that passes, every dealer that runs out of inventory, every premium increase, every delivery delay, that window gets smaller. The people who are going to benefit from this shortage are the ones who position before it becomes obvious to everyone. Once it's on the front page of the Wall Street Journal, once your financial advisor is calling you about silver, once premiums are $15 over spot, it's too late to get in at attractive prices. This is one of those situations where being early looks the same as being wrong, right up until the moment it doesn't. The people who bought silver 6 months ago when premiums were $2 over spot probably felt like they were overpaying. Now those same people are sitting on metal that would cost them $7 or $8 more per ounce to replace. 6 months from now, today's premiums might look like a bargain. Or maybe the shortage resolves, mine supply increases, industrial demand moderates, and silver goes back to being a sleepy market that nobody pays attention to. But I'll tell you this, the dealers I'm talking to, the people who've been in this business for decades, they're not acting like this is a temporary blip. They're acting like something fundamental has changed. They're raising premiums, extending delivery times, and in some cases, simply refusing to take orders because they don't know when they'll be able to source metal. That's not normal market behavior. That's not a temporary supply disruption. That's a market that's broken and doesn't know how to fix itself. The silver supply isn't gone yet, but it's going. And once it's gone, once dealers are completely out of inventory, once industrial users can't source metal, once the shortage is undeniable, the price discovery process is going to be violent. Because at that point, silver isn't worth what the futures market says it's worth. It's worth whatever the last buyer is willing to pay to secure the last available ounce. And in a true shortage, that number can be a lot higher than anyone expects.